Another sharp move higher in long-term bond yields is colliding with an AI earnings boom, and equity markets are being forced to choose which story they believe. Welcome to vTalkInsight, Equity Pulse Daily for May 21st, 2026. Today we unpack how the global yield shock, the energy and inflation backdrop, and the latest AI and consumer signals are reshaping risks and leadership across equities. Global bond markets are under heavy pressure, and that is now a central part of the equity story. Longer maturity government bond yields in the United States, Germany, the United Kingdom, and Japan have pushed up to levels last seen around the global financial crisis, with the United States 30-year yield back near its highest since 2007. The drivers span renewed worries about persistent inflation, large fiscal deficits, heavy supply, and lingering energy shocks. In the United States, markets are even pricing several rate hikes this year, while some macro views argue that looks inconsistent with an eventual growth slowdown and that front-end rates may already be too high. Federal Reserve leadership is signaling patience, with little appetite to cut near-term unless energy prices retreat and core inflation drifts closer to roughly 2.5%. The European Central Bank is also stressing a meeting-by-meeting, data-driven approach, and the Bank of England has just seen a softer inflation print, yet still expects price pressures to re-accelerate later this year as energy shocks from the Iran conflict filter through. The macro tension is intensified by geopolitics and energy. Shipping through the Strait of Hormuz is running at only about one-fifth of pre-crisis levels, while analysts warn that even a rapid ceasefire would still leave oil flows impaired for months. Forecasts for Brent crude near $100 into year-end, potential United States gasoline prices around $6 a gallon, and ongoing strategic petroleum reserve draws all point to a stubborn energy premium. That combination of high yields and energy costs feeds stagflation risk and raises the hurdle for long-duration equities, even as headline volatility measures like the VIX remain only moderately elevated and the S&P 500 continues to recover quickly from pullbacks. Against that tightening rate and energy backdrop, artificial intelligence has become a macro growth engine in its own right. AI-related capital expenditure added roughly 0.8 percentage points to United States GDP growth last year, and a similar boost is expected again, mainly through software and equipment investment. Infrastructure spending is scaling rapidly, with forecasts for AI data center investment climbing toward $3 to $4 trillion a year by the end of the decade and hyperscalers projected to lift aggregate capital expenditure toward $1 trillion next year. So far, credit markets are willing to fund this build-out. Tech sector bond issuance is running at several times recent averages, and deals such as Oracle's $25 billion transaction drew more than $130 billion of orders. Recent AI data center financings are being structured with longer leases and debt maturities that match the life of the assets, so technology risk and refinancing risk are more tightly managed. As a result, despite higher real yields and expectations that corporate spreads could eventually widen, credit risk around core AI infrastructure remains described as contained. The economic impact is two-sided. The initial phase of the AI boom is clearly demand-heavy. Consumers and businesses are spending in anticipation of future productivity gains, helping keep labor markets tight and adding to near-term inflation pressure. Banks are planning 10 to 15% workforce reductions in more routine roles as they invest in AI to lift efficiency, and companies from Kava to Intuit are deploying data and AI tools to drive operational gains. Over time, if adoption is not choked by premature regulation, AI-driven productivity has the potential to push down the cost of many goods and services, including by speeding up regulatory processes like building permits, which could eventually help ease some structural inflation pressures. Nowhere is the clash between rates and growth more visible than in semiconductors. Chip stocks have delivered roughly three-quarters of the S&P 500's price appreciation this year, with Nvidia alone contributing around one-fifth of the index gains. Forward earnings estimates for the sector are up about 90% since October, reflecting extraordinary demand for accelerators and memory tied to AI workloads. At the same time, technical strategists warn the move looks stretched and market leadership has become notably narrow. Nvidia sits at the center of that story. The company has just delivered another major earnings beat, with quarterly revenue around $82 billion, up roughly 85% year-on-year, and a similar jump in adjusted profit. Second quarter revenue guidance near $91 billion with gross margins around 75% topped both consensus and many buy-side expectations. Free cash flow is running near $49 billion a quarter, and Nvidia has expanded its share buyback authorization by $80 billion, lifted its dividend to 25 cents, and signaled that total capital returns could reach hundreds of billions of dollars over the next several years, even as it continues to fund heavy investment. Beneath those headline numbers, Nvidia has locked up much of the upstream supply chain, lifting supplier purchase commitments from about $50 billion to $90 billion and covering the majority of key components through 2027. Older architectures such as Hopper and Ampere are actually appreciating in value as they transition to inference workloads, with cloud pricing for Hopper reportedly up more than 30% this year, underscoring how demand for accelerators is growing several times faster than supply. Yet the stock's forward price-to-earnings multiple has already compressed from more than 40 times in 2023 into the mid-20s. Options markets show signs of extreme call optimism, and even a strong beat has been met with a muted share price reaction. Add in potential supply shocks from risks like a strike at Samsung's memory plants or outages at leading-edge facilities, and the sector carries both powerful earnings momentum and meaningful downside volatility risk. Outside mega-cap tech, the earnings picture is better than the headlines suggest, but the consumer is sending a more nuanced signal. First quarter reporting has been exceptionally strong overall, with around 90% of companies beating estimates and S&P 500 earnings per share growth running about 26% year-on-year, the fastest since 2021. Retailers such as Target and Lowe's have delivered upside surprises, and Target just reported its strongest sales growth in 4 years, with same-store sales up 5.6% and traffic up 4%, while value-focused strategies are benefiting Walmart and TJX as consumers trade down. Even so, margin pressure is real. Target's shares fell more than 5% after highlighting higher fuel, plastics, and fertilizer costs. Reminder that input inflation can quickly erode retail profitability. There are bright spots in housing, where Toll Brothers has raised full-year guidance as new home orders hit a 2-year high, suggesting many buyers are adjusting to elevated mortgage rates. Other company-level stories point to idiosyncratic growth. Cava is posting over 9% same-store sales growth while taking smaller price increases than the wider restaurant industry. Intuit has beaten earnings and raised guidance on the back of its AI-driven restructuring. Airbnb is extending its ecosystem into services like groceries and airport pickup. And Hasbro is leaning on franchises such as Star Wars and Avengers along with strong growth in Magic: The Gathering. In parallel, private markets and the IPO pipeline are setting up the next phase of equity flow dynamics. Traditional private equity deal activity remains near multi-decade lows as buyers and sellers still wrestle with valuation anchors from 2021 and 2022, and funds are allocating more toward core infrastructure and essential services to seek inflation protection and lower volatility. Looking ahead, upcoming mega listings from AI-focused companies such as SpaceX, OpenAI, and Anthropic could potentially quadruple last year's IPO market value. Index providers and large passive funds may have to absorb new market capitalization quickly, which could crowd out smaller incumbents, but might be cushioned by liquidity still sitting on the sidelines. The SpaceX deal in particular is expected to feature only about 4% of the company in free float, a dual-class structure that leaves Elon Musk with dominant control and substantial capex commitments to AI, including plans for GPU-heavy, space-based data centers, all of which could add both powerful new AI exposure and elevated governance and volatility risk to public equity markets. Putting it all together, equities are caught between a powerful AI-led earnings and capex cycle and the stiff headwind of multi-decade high long-term yields, persistent energy shocks, and geopolitical uncertainty. The bond market is signaling a higher for longer regime, while the equity tape is still being held up by a narrow group of semiconductor and AI beneficiaries whose earnings, like Nvidia's, continue to surprise on the upside but already embed demanding expectations. Beneath that surface, earnings breadth is healthier than the concentration narrative implies, with retailers, select housing names, and a range of consumer and software companies still posting solid growth even as discretionary demand softens and input costs bite into margins. Credit markets remain open for now, helping to fund the AI infrastructure build-out, but issuance is heavy and there are growing forecasts for wider spreads as supply, real yields, and inflation risks persist. Over the coming weeks, the key signals to watch are the trajectory of long-end bond yields, any escalation or de-escalation in Gulf energy disruptions, how semiconductor supply and pricing respond to potential shocks in memory, and the terms and reception of upcoming AI-heavy IPOs such as SpaceX and, later, OpenAI and Anthropic. Those factors will go a long way in determining whether today's narrow leadership broadens out or gives way to a more material valuation reset. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.